Is the bottom in for real estate? Is there more pain to come? And what can we expect for the remainder of 2023? Stick around as we share our perspective on where we think the GTA real estate market is headed.
Toronto's housing market is heating back up.
After 8 interest rate hikes in a row, the central bank is cooling its jets for now.
Now, the population of this country grew by more than 1 million last year.
Dreams of home ownership in this country may be out of reach.
The FDIC just reported the California regulator shut down Silicon Valley Bank.
Welcome back. Thanks for watching Amani from Sweet Additions, where we help investors and homeowners create more housing and generate wealth. We really appreciate if you can hit the like button, and would be awesome if you can subscribe to this channel so that we can get more content out. You can also read a more detailed version of this video in our blog post at sweetadditions.com. Additionally, we're actually working right now on putting together a comprehensive in-person training program covering in detail the principles, strategies, and tactics as part of the Max Suite strategy. We'll share more info at the end of this video, and you can also check it out at sweetadditions.com/training. Okay, so let's dive into this heated topic of GTA real estate. Before we do that, you might be wondering, why the heck do we even have the authority to talk about this stuff? And what does this have anything to do with adding additional suites? After all, we're not economists or real estate professionals. If that's what you're thinking, you're absolutely right. We don't have any authority to talk about this, and we're going to do so anyways because these so-called experts have been wrong again and again. And the reason why we want to share our view is because as homeowners and investors ourselves, we have to navigate the overwhelming amount of information out there and have to make educated decisions for ourselves. Now, the objective here is just to give you our perspective. So please take whatever we say here with a massive grain of salt and do your own research. And the reason why this has to do with additional suites is because we all have to own the real estate first before we can do the projects that we talk so much about here on this channel. We're in the exact same shoes as many of you watching, so we're just trying to figure this out along with you. So the disclaimer here is that nothing we say here is investment advice. Everyone's situation is different, so please consult a professional. Now, with that out of the way, let's dive into the real estate numbers this past month. So in March of 2023, Trev data shows that the average price of a home was up slightly from February, but still down 15% year over year from last March. This is actually less than the 18% between February of this year versus February of last year, which may be a sign that things have stabilized in terms of prices. However, this is not the interesting piece of news from the March numbers. The bigger news is that this March saw only around 8,000 new listings compared with 15,000 last March. That's almost 50%. And people were complaining how little houses were available last year at this time. So we'll get back to this in a bit. Currently, at the time of this recording, our Bank of Canada's key interest rate is 4.5%. Now, if you were on a variable rate mortgage this past year, this would have definitely hit you hard. I sure got it pretty rough myself. However, it's quite possible that fixed mortgage rates could come down in the coming year. This is because the broader market, through bond prices, is betting that there will be no more rate hikes this year and possibly even a reversal. And fixed mortgage rates typically follow what's happening in the bond market. So let's shift gears now and talk a bit about the big macro picture, which ultimately plays the biggest role in determining where things are headed. Now, if there's a single chart we'd like to draw your attention to as to what's happening in the big picture, it's this chart. This is the total public debt levels in the United States up until 2008 at around $8 trillion. Now, if you thought this was scary, here's another chart showing 2008 in this circle, and we're here right now, okay? Around 4 times what it was in 2008 at close to 32 trillion. So now you're wondering, what the heck does this have to do with GTA real estate? Bear with us here. Our predicament here in Canada is much the same, except at a smaller scale. The reason why we're showing US data is because this is an indication of most of the Western world. At the same time as debt levels are going at an exponential rate, they're trying to raise interest rates, and these rate increases is starting to wreak havoc in the banking system, as we've seen in the past few weeks. And even worse, the government themselves have to pay a much higher amount of interest on their own debt. In the US, these are treasuries with varying maturity dates, and in Canada, we have our own federal bonds that the government needs to service in the short and long term. The math simply doesn't work. The debt levels have already gone way beyond to the levels where the economy can continue to grow to support it. And this doesn't even include hundreds of trillions in liability to public pensions in the US. With less and less entities interested in owning government debt, the central banks will ultimately need to be the buyers of last resort. And you know what that means. You got it. More money printing, which means likely continued inflation in the coming years in hard assets like real estate, equities, and other commodities that cannot be printed. You see, they can only control inflation so much. And there are 2 sides to inflation. First type of inflation, which they've been able to largely control through the recent aggressive rate hikes, is credit creation through bank lending. The second type of inflation, which they cannot control, is the demand for real products and services that people need. Stuff like food, energy, healthcare, education, and oh yeah, houses. This is the reason why inflation is still high and likely why house prices are relatively stable, despite the fastest rate hikes in over 2 decades. The 4 or so % that we have today is actually more aggressive than the double-digit rates in the 1980s. That's because the government is in so much more debt. In Canada, the debt 40 years ago was $95 billion and today it's $1.2 trillion, 13 times the amount. Basically, in order to keep the system going, more and more debt needs to be added on. Think of it like maxing out your credit card and then getting a new credit card to make the interest payments on the first one. This is probably the main reason why house prices have pretty much gone parabolic in the last decade or so. Now, to keep things simple, what this means is that the government is likely going to have to live with the fact that inflation is here to stay, and they may increase their inflation targets above the original 2%, and at the same time likely adjust how they actually measure inflation to make it seem like it's not as bad as it actually is. This is what they call hedonic adjustments, and they've been doing that already for decades, and they'll likely continue to do so. As a matter of fact, the U.S. Bureau of Labor Statistics back in February announced that it will change the way it measures inflation. Now, our guess is that they're probably going to try to bring that number down artificially. So given all this information, from a big picture perspective, we feel personally that owning hard assets rather than cash or debt instruments makes more sense for us in the long term. All right, so now that we've thoroughly bored you to death with all of this economic mumbo jumbo, let's shift gears again and take a look at the local situation. In Canada, we had 1 million new people in 2022. Some are permanent residents and some are on work or student visas. Regardless of their status, these folks also need a place to live. At the same time, getting new homes built is harder than ever. The rate increases have made it challenging for many developers to get the funding needed for construction. This often results in them having to postpone their projects. Even if they're able to get the funding, there are still a gauntlet of challenges, including municipal bottlenecks, expensive materials, and a severe shortage in skilled labor. We ourselves are experiencing these challenges firsthand, and all of these more localized issues are really just the additional fuel to the raging fire that's happening in the macro picture, which we outlined above. So this is why we feel that it's up to many small investors and homeowners to provide additional housing through grassroots development with things like additional suites, garden suites, and small-scale infill development. And this is also where there's a tremendous amount of opportunity. In the longer term, we feel that people will slowly adapt to reducing their living footprint in high population urban cities, becoming accustomed to smaller units and living in subdivided homes. And smaller living footprints are common in the places where many of the new immigrants are coming from. So for them, living in a subdivided home that is constructed nicely is likely to be a desirable living arrangement. And we feel like owning a single-family property today is like owning a multifamily property in a few short years. So we've come to the conclusion that the big picture macro trends, along with the severe shortage in housing options locally, is what's keeping prices relatively stable here in the GTA. And housing is just one component of our over-leveraged economy. And any significant drops in prices beyond what already happened last year will likely indicate that there are bigger problems beyond just housing. It's very hard to reverse this chart here in our current debt-based system. So based on everything discussed here, you're probably wondering what we're doing. As it stands right now, we own several properties but are not quite in acquisition mode as we recently acquired a property back in December. Rather, we're in holding mode and trying to improve the value of what we already have. We're definitely not intending to sell in the current environment. We're fairly comfortable knowing that given the big picture, holding on to hard assets is probably a safer bet. Again, all this is just to let you know what we're doing based on aggregating all the information that we're looking at. Of course, there might be blind spots that we don't see and we can be entirely wrong, and that there can be another huge drop in property prices this year. Things are really unpredictable and that could happen. The current banking system is quite unstable, and with the aggressive rate hikes this past year, we're starting to see cracks in the system, and there's a chance of some bigger event that will happen this year causing everything to deleverage, including housing. But given the past experience, this might be short-lived as government and central banks will likely rush in to backstop any severe decline. And we saw this in 2008 and in 2020 during the pandemic with huge amounts of liquidity. Remember, nothing is 100% certain. We're only dealing with probabilities, and you need to make financial decisions based on probability, which is very difficult. And none of this, of course, is to tell you to buy real estate or even not to sell your property. Your situation is unique and your outlook might be different. Just remember one thing is that whatever action or inaction that you take, you're effectively making a decision in your financial future. And just like there were everyday people after the financial crisis of 2008 not getting into the housing market thinking it was overpriced, I was actually one of those people until I dug deep into how the economy worked and how deeply in debt our entire system is, and that they essentially just have to keep increasing the debt levels. However, there is one thing that we will advise people of without hesitation, and that is this. Do not be over-leveraged if you're considering getting into real estate. This past year, we have seen a lot of people in the investing space really struggle, especially those who got into the market aggressively at the peak and have had multiple properties that are negative cash flowing by thousands of dollars. Make sure that you have a decent amount of down payment and that you can more than cover the mortgage payments and expenses associated with the property. The coming years could be very volatile with market conditions changing rapidly and policy designed to tackle whatever crisis is in front of us. Focus on greater income generation and reduce unnecessary expenses. If you're a business owner, try to increase your revenue and profit margins. If you work for a company, try to earn more money or start a side business. And if you do decide to either get into or stay in real estate, make sure to focus on doing things that you can control. Now, in the past, we've outlined a bunch of these things that you can do to ensure that you mitigate your downside as much as possible while helping to increase the upside. Now, it's been a while, so we'll quickly go over these items again. Number one, invest in cities and towns that have good local economic fundamentals, a strong labor market, and increasing population. Additionally, make sure that they have progressive housing policy geared towards housing density. Number two, within the cities, find out where the areas of growth are and invest in properties in proximity to those areas. Number three, focus on property types that are ideal for convertibility to multiple units where you can focus on the max suite strategy, both to the existing structure and for new detached structures. Number four, see where you can force appreciation, whether it's cosmetic upgrades, curb appeal improvements, or adding more units. Number five, focus on multiple sources of income on that property. Try to come up with creative ways to create more cash flow. An example is renting a garage for storage. Number six, as a minimum, add in a second unit and possibly a third or fourth unit depending on the zoning of the property. Number seven, take advantage of slight price advantages through seasonal market cycles, such as lower prices in July and December. And finally, number eight, try to negotiate a good deal with the seller by creating a win-win situation. Okay, so that's all we have for you right now. Hopefully that was helpful. Now, if there's two takeaways that we want you to have from this video is that we think the upcoming months and years will be very volatile, but that doesn't mean you shouldn't take action. Calculate your risk carefully and don't be over-leveraged. And remember that there's a bunch of things that you can personally control to increase your chances of greater success. Again, we're putting together an in-person comprehensive training program later on this year implementing the Max Suite strategy. If you're interested, please go to suiteadditions.com training to apply, and we'll keep you updated on the training. In the meantime, continue to focus on creating better homes and generating lasting wealth. Thanks for watching, and we'll see you in the next video. To learn more about the Max Suite strategy, download our free guides at suiteadditions.com and get started. And if you enjoyed this video, here's another great one for you.